Alright, it's Unit 3, Property and Casualty. We're gonna calm it down so our voice isn't muffled so much. Rates, judgment manual, experience rating. These are the three basic ways that which underwriters assign rates. Judgment rates, manual class rating, experience rating, merit. When using judgment rating, the premium is determined by considering the individual risk. No books or tables are used. Premiums are established through careful judgment and experience of the underwriter. Manual or class rating uses company rates for a particular state of era that are contained in its manual. Rates are arranged by various categories or classes. The underwriter classifies the risk according to defined criteria and then looks up the appropriate rate. The rate per unit insurance is then multiplied by the number of units of the insurance being purchased. To calculate the premium, the formula looks like this. Rate per unit times number of units equals the premium. For example, an insured purchased 60,000 of insurance at a rate of $2 per thousand of coverage. To calculate the units, just divide the amount of insurance by 1,000. In this case, there are 60 units. $2 rate per unit equals 60 units equals $120 in premium. Experience and rate is most commonly associated with workers' compensation. Actual loss experience is compared to historical loss data for a participating rating class. An experience modification factor is developed from this information and can either be increased or decreased. The premium on the policy based on the loss experience we see. Other types of merit ratings include retrospective ratings, which is based on the insurance premium on the losses incurred during the policy premium. The scheduled rating. This applies to systems of debts and credits to reflect characteristics of a particular insurer. These are the three ways that we assign rates today. Judgment, no set rates based upon the underwriter's experience. Manual class rates for the specific rate class, risk class. Experience rating modifies the base based off loss experience. Increased for decreased premiums, usually a 3-year period. Loss costs. Companies use their own past claims information to help them form future claim costs. However, there are times when a company uses this claim data for outside organization for the purposes of establishing claims, costs, and different types of risks. One such organization that provides the information is called the Insurance Service Office, ISO. Their claim data includes pure losses and does not include any costs for company expenses or profits. Loss costs, claim costs, loss costs, pure claim data, no operating expense included, no profits included, rate components. Factors that determine premium rates include loss costs, the amount the company thinks they will have to pay and the claim is made, cost of handling claims, operating expenses named, the profit in insurance companies employs actuaries to calculate these rates. Rate components, loss costs, estimate of claims costs, claims handling costs, operating expenses, and profits. Federal law and regulations. Fair Credit Report Act, the FCRA, U15, USC Section 1681, 1681D. The Federal Fair Credit Reporting Act requires consumers reporting agencies to adopt reasonable procedures from exchanging information on credit, personal insurance, and other subjects in the manner that are fair and equitable to the consumer with respect to the confidentiality, accuracy, relevance, and proper use of the information. All insurers and their producers must comply with the Federal Fair Credit Reporting Act, regardless information obtained from third parties concerning the applicant. Reports on consumers are prohibited unless the consumer is made aware that the investigation consumer report may be made, and and that such report may contain information about the person's character, reputation, personal characteristics, and lifestyle. A notice to the applicant must be issued to all applicants for property and casualty and life or health insurance coverage. The notice informs the applicant that the report will be ordered concerning the credit history and other life and health insurance for which they have previously applied. The agent must leave this notice with the applicant along with the receipt. This notice must be given to the consumer no later than 3 days after the report is requested. A consumer may make a written request for the complete disclosure of the nature of the scope of the investigated, underlying, and report. Disclosures must be made and written within 5 days after the date of which the consumer request was received. Consumer rights. Consumers who feel that information in their files is inaccurate or incomplete may dispute the information, and the reporting agency may be required to reinvestigate the correct or delete information. The insurance companies may use consumer reports or investigative consumer reports to compile additional information regarding the applicant. If applicant feels that the information complied by the Consumer Inspection Service is inaccurate, then they may send a brief statement to the reporting agency with the correct information. Penalties. Violators of the Fair Credit Reporting Act may be subject to fines and imprisonment, as a matter of fact, and may be required to pay any actual damages suffered by the consumer, punitive damages awarded by the court, and reasonable attorney fees. The maximum penalty for obtaining consumer information reports under false pretenses is $5,000, imprisonment for 1 year. Fair Credit Reporting Act. Fair Credit Reporting Act. All insurers and producers must comply. Notice to the applicant within 3 days after reporting was requested. Maximum penalty $5,000, 1 year in prison, or both. Terrorism Risk Insurance Program Reauthorization Act of 2019, TRIPRA. As a result of the terrorist attacks on the United States of September 11th, as a matter of fact, 2001, Congress enacted, the President signed into law the Terrorist Risk Insurance Act, TRIA, of 2002. It was reenacted in 2007, 15, and 19. We see the title of the act is now the Terrorism Risk Insurance Program Reauthorization Act of 2019, TRIPRA. The extent of the program through December 31st of 2027. This federal law defines acts of terrorism and imposes certain obligations on insurers. The definition of terrorism is the violent act or acts that is dangerous to human life, property, or infrastructure that results in damage within the United States or outside the United States committed by either domestic or foreign terrorists. An act of terrorism must be certified by the Secretary of Treasury in consultation with the Secretary of Homeland Security and the U.S. Attorney General. Until recently, the Secretary of State, rather than the Secretary of Homeland Security, was one of the federal officials who were part of the certification process. The act was designed to limit the exposure of individual insurers and the insurance industry as a whole, and to make the insurance available and affordable under the system where the federal government participates and shares the risk of loss. There are several key provisions included in the act to trigger events for the group and going into effect. It was $100 million to increase to $200 million in 2015 to 20 and $20 million increments. Each insurance carrier deducted is set at 20% of their direct earned premium from the prior calendar year. This is the amount the insurer must pay before the federal program provides compensation. The federal shares of the compensation that exceeds those deductibles decreased from 85 to 80 by 2020. The congressional retentions in the insurance market increases from $27.5 billion to $37.5 billion by 2020. The insurance market aggregate retention amount was established at $37.5 billion. The cap on federal liability is not to exceed 100 billion. Tripura, Tria. Results from the 9/11 attacks on the United States of America. Congress originally enacted in 2002 limits exposure of insurers in case of another catastrophic event. Triggering event must be at least 200 million. The Graham-Leah-Bailey Act, 15 U.S.C. Section 206. The Graham-Leah-Bailey Act, GLBA, was passed in 1999 to allow financial holding companies to engage in activities that are financial in nature on this page. Regulations of these holding companies is managed on the functional basis. This means that regulatory authority is based on what activity is occurring rather than what type of the company is engaging in the activity. For example, the sale of insurance is regulated by the state insurance regulators, even if the company making the sale is a bank or a securities broker. The GLBA requires financial institutions, companies that offer federal consumer financial products or services like loans, financials, and investment advice, and insurance companies to explain their information, sharing their practices to their customers, and to safeguard sensitive data. Financial holding companies have the potential to capture unprecedented amounts of information about their customers. To address these concerns, the GLBA also established a minimum federal standard for financial privacy. GLB states that each financial institution has a responsibility to respect the privacy of its customers and to protect the security and the confidentiality of those customers' non-public personal information. The law requires that all functional federal regulatory agencies establish appropriate standards for each regulated institution with respect to the technical administration and physical safeguards to ensure the safety and the confidentiality of customers' records and information, protect against the anticipated threats and hazards to the security and integrity of such records, and to protect against unauthorized access or to use of such records for information that could result in substantial harm or inconvenience to any customer. Anyone about whom a company collects information is a consumer. A customer is a consumer who has an ongoing relationship with a financial institution. Different states define ongoing relationships using different guidelines, so be certain you understand what it means in your state. The opportunity to opt out must be offered by the financial institution when an account is established and annually thereafter. Let's talk about the GLBA. Protects the confidence of the personal information. The act considers information to be collected when the organization can be retrieved by an individual's name or by an identifying number, such as a policy number. The source of the information is less important on how it is stored and organized. Information this is publicly available, such as phone numbers listed in the telephone book, is not protected under the GLBA. However, the fact that the individual has an insurance policy with a certain company is not public information, so publishing a list of policyholders' names and list phone numbers will not automatically be allowed. Business information is not covered under this statute. The Graham-Leah-Bailey Act. Consumer customer. A consumer is anyone about whom information is collected. A customer is someone who has an ongoing relationship with a financial institution. The opportunity to opt out must be offered by financial institutions when the account is established and annually thereafter. Fraud and false statements. 18 U.S.C. Section 1033 and 1034. The The person who transacts insurance in interstate commerce and who intentionally makes false material statements in connection with the financial report are documents presented to insurance regulators appointed to investigate the person and attempt to influence the action of such subjects to a fine, imprisonment for up to 10 years, or both. Imprisonment may be ordered for up to 15 years if false statements jeopardizes the safety and soundness of the insurer and were a significant cause of the insurer being placed in conservation, rehabilitation, or liquidation by the court. Officers, direct agents, and employees of the insurance company who willfully embezzle or misappropriate funds are subject to the same consequences described above. Fraud and false statements. It is illegal to make false statements. If guilty, you can get fined up to 10 years in prison or both. Up to 15 years in prison if the false statement jeopardizes the insurer. It is illegal to make false statements. If guilty, fine up to 10 years in prison or both. Up to 15 years in prison if false statements jeopardizes the insurer. This is KING-KAMBUF, 100 proof, bringing you nothing but the truth. This is property and casualty insurance. And that's the end of chapter 3. I'm going to come back with another track that just goes into the review, the cram. KING-KAMBUF, 100 proof, bringing you nothing but the truth.